Hi guys, I am AP. In this video, we are going to see the chapter 20 in the book The Intelligent Investor. The chapter 20 is margin of safety as a central concept of investing. Okay, let's get started. Graham says the one thing we can't avoid in the market is risk. The key is how well we are managing the risk. To avoid the risk while investing in share market, Graham advises the margin of safety as a key of investing. The margin of safety is how much percentage we are buying the company share below its intrinsic value. That's the margin of safety. Higher the percentage below the intrinsic value we are buying, the higher the margin of safety is for us. Okay. To find the intrinsic value of the company, there are many methods like discount cash flow method, free cash flow method, the asset ratio, and so on. Let's consider a company share is trading at 500 rupees and we are finding out that the intrinsic value of the company is 100 rupees. Then if we buy the share below its intrinsic value, that is 80 rupees, then our margin of safety cushion is 20%. So that we are having the higher margin of safety as 20%. The intrinsic value of the company is 100 rupees. We are buying below it so that our risk of downside is limited and we have a potential upside growth in the future. Okay, now let me give you one real-time example. The company Infosys. It's a large cap company and the company's finance is so good. The company has a less debt and have more assets. Okay. Now we are seeing the weekly chart of the Infosys company. Now we are at October month 2023. Now the weekly closing of the price is 1431 rupees. Okay. Now it is a current market price. To calculate the intrinsic value, I am simply googling it. The intrinsic value of Infosys. The Google says the projected FCF is free cash flow method is 649 rupees. We know the current market price is 1400 rupees and the intrinsic value is 650 rupees. Okay, the 20 percentage of 650 is 130 rupees. Okay, as for now we know the intrinsic value, current market price, and we are going to have a margin of safety at 20 percentage, so that the 20 percentage of 650 is the 20 percentage of 650 is 130 rupees. We are going to minus 130 from the 650, so we are arriving at 520 rupees. Okay, now in the chart let me plot. Okay, now the current market price of the Infosys is 1431 rupees and we find the intrinsic value of 650 by calculating the free cash flow method, and the 20% to intrinsic value is 520 rupees. The Graham's advice is we should buy below its intrinsic value, that is 650 rupees. Now the margin of safety I am choosing is 20%, so that the 20% of 650 is 130 rupees. I am minusing it from that, and 530 and 520 is the correct price for me to buy the stock, so that in the long term we can make profit out of it. We should not apply this for any random company. According to Graham, the first 1 to 9 chapter is all about how to select a company. The company should be large company, a well-known prominent company, and the company's finance should be a stable company. If the company passes all the tests, then only we should check the margin of safety for that company. Okay. The Buffett advises that buying below its intrinsic value, it is called the value investing method. To be the defensive investor, we should do this only. We should select the company, know the intrinsic value, buy below it, and let it for long term so that we can get profit out of it. Okay. That's the Intelligent Investor book from chapter 1 to 20. In next few videos, we are going to see the complete summary of this book. Till then, stay tuned. Thank you.